Hi everyone, welcome to the Buffett and Beyond Research Stock Analysis, and we're going over good old Alphabet, which of course we all know as Google. And these methodologies are based on the book Buffett and Beyond, second edition. And remember folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's go over Alphabet a little bit, which of course is the successor and parent holding company of Google, which operates the world's leading internet search engine. Now, the company derives revenues primarily through delivering targeted advertising. So when you look up something on the internet, all of a sudden a little ad will pop up sooner or later of trying to sell you that particular item that you were looking up. And revenues are also derived from the licensing of search technology and solutions to enterprises. Revenues in the United States, 48%, international 52%, has 190,234 employees, owns YouTube, Google Search, and Google Cloud. And let's take a 5-year average look at the average stock in at Google. Now, the average stock is in blue, so these blue lines here represent the clean surplus return on equity, net income, and revenue. Green line is Google, and we can see that the return on equity, and this is the clean surplus return on equity, is almost not quite double the average stock out there. Net income, it is just about doubling the average stock out there. And revenues, 2.5 times the average stock. So we're looking at a stock that is outperforming the average stock in all areas. Now remember, what we are trying to do is outperform the S&P 500, and we do that almost year after year, and over the long term we certainly do. Because 96% of professional money managers cannot outperform the S&P 500 over any 10-year running period. And that's a report out of Morningstar from 2002. So again, very few people can outperform the S&P 500. And so if we're trying to do that, we might as well put stocks in our portfolio that outperform the average stock out there, or the average stock in the S&P 500. Google is certainly doing that. These green vertical lines show that it's outperforming the average stock in just about every way out there. Now, let's look a little closer, and we see that net income, and this is the clean surplus earnings. Net income has gone up every year except for 2022, when it dropped down a little bit. And now for this year, it is up to $5.65. And these are relatively new numbers because this number had been $5.40. So it's been raised 25 cents. And for next year, it was projected to be, projected to earn $5.95, and now they're projecting it to earn $6.70. And this happened just over the past several months, where these numbers were raised. What does that do? That raises the clean surplus return on equity. Now, what is the clean surplus return on equity? Simply think about it like a bank account. How much are you getting in a bank? Let's say you're getting 4%. Well, 4% is the return on your equity that you put in the bank. And so the average stock out there has a clean surplus return on equity of 13%, where Alphabet has a clean surplus return on equity averaging over 20%. So the question is, would you rather put your money in bank S&P 500 and get 13%, which eventually turns into growth, approximately 13% per year, if you include dividends, or would you rather put it in bank account Google that has a 20% return on equity? There's not much of a question there. And look at this retention rate. Retention rate is how much the company is making and putting back into itself in order to grow. Google is still growing. It's still in the growth stage, putting all the money it makes back into itself in order to grow. We just discussed the net income and the revenue growth way above average, and for 2024 expected to be above average. 2023 this year, which is coming to a quick end, is above average. 5-year growth certainly above average. Now, years to pay debt, Buffett's rule. He says if a company takes all the money it's making, how long will it take to pay off the debt. His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. And this company can pay its debt off in less than 2 months. Very, very nice, folks. So let's look at how this stock has performed year to date. Well, black line is the S&P 500. Black line with 20%, or I should say 19% return, is really almost doubling what the S&P returns on a year-to-year date, and I'm talking about the index. It's about 9 or 10. It's actually 9.56%. Just happened to know that number over the past 22 years. So right now, this S&P 500 is doubling its average return, but that's because last year it fell almost 20%. So we're averaging out here, and sooner or later we'll get back up into the averages of around 10%, and I'm talking about the index. Meanwhile, what's Google doing? About 45%. This is year to date, folks. This is just 2023, minus about a half month yet to go. And so this stock is more than doubling the average stock in the S&P 500. And over 5 years, same thing. 5 years, the S&P is up 75% over the 5-year period, where Google is up 150%. So we're looking at a stock that almost doubles the S&P over the year-to-date period, plus over the 5-year period. So we have a very, very good stock here. And just a few things, Waymo, which is the autonomous driving technology company, could prove to be a huge boon to Alphabet. And Jefferies, and that's the rating agency, upped its rating agency and banking and stock brokerage, upped its long-term value estimate for Waymo to $250 billion from the previous range of $75 to $125 billion. So it doubled its range for long-term value. We have, not we, but Google, well, we, because we own Google, 500 driverless taxis in Phoenix, now testing in San Francisco. And if it could do good in San Francisco with all those hills and all those curves, yeah, Phoenix will be a piece of cake. So, folks, we're looking at Google. We're getting ready for the 2024 portfolios, and Google will remain in our portfolio. It's been in there for a long time, and we like Google. It's doing well. It's expanding. It's in AI. And so, folks, Google, yeah, one of our favorites. All right, folks, we had a good month in November. We're having a pretty good month in December, and we have everything going for the market. Interest rates are coming down, which is the important thing. So you take the weekend off, go out, clear your head, be with your friends, be with your family, watch television, do whatever you want, because guess what? The market will be open on Monday again.